This is Nick here, about to go through the inflation chart book. This is the first inflation chart book, so I'll try to provide a little bit of context for each slide. So starting on the first chart here, this is the average of four common measures of U.S. inflation. So it's the headline CPI year over year, the core CPI year over year, the headline PCE year over year, and the core PCE year over year averaged together, just to take a kind of general reading on the inflation picture. And as you can see, we're back above 2%. 2% is the inflation target for the Fed. Part of that is related to base effects, meaning that at this time a year ago, basically just meaning that there was a kink in the inflation indexes from a year ago, which is best captured in the second chart. You can see that basically from kind of March through the summer of last year, there was either a down kink or a flat period there. And if you just envision basically fairly steady month-over-month readings as you get into the year-over-year period, where the back end is that flat part or that down month from 2017, that's gonna bump up the year-over-year reading just purely on the basis of what are called base effects. One of the biggest drivers for base effects is the oil price. You can see there on chart 3 the basically the cumulative 1-year percentage return for the oil price. It's been moving really steadily higher over the past year off of the dip down from June of 2017. So June of 2018, and this kind of just assumes a relatively stable or higher trending oil price over the next month or so. You would expect to have the greatest kind of year-over-year percentage increase in June 2018 compared to June 2017. All right, then moving on to chart 4, this is the one market expectation regarding inflation. That's the black line. That's the 5-year forward CPI annualized inflation expectation. That's a directly tradable market instrument. So I think it's a helpful data point to cross-reference. What's interesting is that it seems to follow pretty closely with the level of the oil price, which is the gray line. And to some extent, that might make sense under, I guess, a theory that you could refer to as the cost push theory of inflation, which I'm really not sure if that's even a good way of thinking about inflation. But I guess the idea there is that, these higher oil prices that are inputs as energy into the production process, those higher production costs would eventually get passed on to consumers and show up in the CPI inflation. But what it looks like to me is that these oil prices actually show up immediately in the CPI readings without a lag, because, for one reason, energy prices are a direct consumer good as well as an input to production. And so it doesn't entirely make sense to me that as you get a higher oil price, you get higher forward-looking inflation expectations. If anything, I think that higher oil prices potentially set up the scenario where you could have negative base effects going forward. Now, clearly it depends on the oil outlook and a number of factors, but I find this chart an interesting one to cross-reference. All right, then looking at labor costs. So I guess similarly here, you could think about this in some sense as an input to the production process, and many economists think that the ECI, or the Employment Cost Index, is actually the better measure for labor costs than, for example, the average hourly earnings that gets attention in the monthly jobs report. But in any case, I've got the ECI in black here with the NFIB Small Business Compensation Plans Index in gray with a 3-month lead. That seems to be somewhat of a decent leading indicator for the Employment Cost Index, and that suggests this continued trend higher. So that, if anything, might add to some inflation pressure as this business cycle continues. Then moving on to chart 6, this is one that I also showed in the Fed chart book. It's the unemployment rate in gray there, and basically the average hourly earnings annualized rate of growth for production and non-supervisory employees in black. And there you can see there's been less of an uptick in that black line than you might expect looking at the prior cycles, where when the unemployment was at the current level, the wage inflation, annualized rate of inflation for wages was close to 4%, and we're still down at 2.6. So I think the Fed is still looking, and many economists are still looking for a pickup there in wage inflation based on this decline of the unemployment rate, which in some ways represents this kind of reduction in labor market slack. Moving on to chart 7, so this is capacity utilization and inflation. And capacity utilization in many ways relates to the same idea as labor market slack, the idea being that as more and more capacity is utilized, and what this is referring to is basically fixed plant and equipment in the U.S. So if you think about factories or bakeries or whatever it might be, to what extent is that being fully utilized? If it's if it's cranking out products 24/7, there's no there's no increased capacity there. There's no slack to tap into. That's not where we are now. We're at about 78% capacity utilization, but as that utilization rate increases, it tends to be somewhat of a leading indicator for inflation. As you can see here, there's a 15-month lead on the capacity utilization rate relative to the core CPI year over year. So that seems to be suggestive of inflationary pressure coming through in the coming year or so. And then similarly, GDP growth and inflation, the GDP year over year reading seems to act as somewhat of a leading indicator for inflation. And then consistent with that is on the following chart, U.S. manufacturing PMI and inflation. Basically here there's a 24-month lead, and that's consistent in the sense that the manufacturing PMI is thought to be a leading economic indicator in general, so this has led a little bit more than the prior chart, which showed the GDP with an 18-month lead. Here we have a 24-month lead on the manufacturing PMIs. Looks like, you can see a downtick there on the right in the gray line, down from about 60 to 57.3. So it remains to be seen whether the cycle high for manufacturing was that February reading at 60.5. All right, then this is a really interesting chart to me. It shows a demographic variable in gray and the core PCE year over year in black, and that gray line is the year over year rate of change in the 15 to 24-year-old labor force led by 7.5 years. And you can see it looks like there is just visually somewhat of a fit there. And I think the potential logic for that is that as you have young people coming into the labor force and then entering their kind of peak borrowing years in terms of taking out first-time mortgages, engaging in family formation, spending on newborns, and all of that kind of thing, you get this kind of impetus of credit creation and spending that can be somewhat inflationary. Now, this chart could be purely coincidental. It's really just a curiosity to me, but it does seem to be in line with some of the charts that we just went through, and might suggest inflationary pressure through the next year or so, and then potentially kind of topping out at the end of next year in 2019 or early 2020. I created this chart in October of last year when the PCE was at 1.3, so it is interesting to see it tracking fairly well with that demographic variable. And one of the things that's nice about demographics is that, once these people are there, it's just a matter of time moving forward as to how old they're going to be in the future. And so it's one of the few variables that we can actually predict with fairly high certainty what that's going to look like in future years. And that is probably best expressed on chart 11, U.S. live births per year. This is just a very cool chart to look at, I think, because it shows you just how big the baby boom generation was relative to the previous generation. I put some years on here, and I think there's debate about how exactly to categorize the birth years for the different generations, but this seems to fit pretty well, and it's 17 calendar years per generation. So, looking at the baby boom generation there, I've got that marked as 1947 to 1963. The total number of births was 68.4 million. That compares to the silent generation, which was birth years 1930 to 1946 of 44.9. So that's a really significant difference. I mean, you've got more than 20 million extra people in the baby boom generation relative to the silent generation, and that I think did have some very significant impacts, namely the inflation and the high interest rates, the rising inflation and rising interest rate periods of the 60s and 70s. And that's somewhat captured on chart 12, U.S. demographics and inflation. So the gray line here is 16 to 20-year-olds as a percent of the labor force. That's led by 7.5 years, and then the 10-year trend inflation rate, which is the black line. That's the CPI year-over-year rate, 10-year moving average. And so you can see there appears to be somewhat of a relationship. This is a debated topic among economists. Many, I think, traditional economists view in their framework, demographics should not have any impact on inflation. Some economists think that aging societies should actually be inflationary rather than deflationary. My own view is that I think it is a factor, and that all else being equal, an aging society would tend to be disinflationary or deflationary. And that's kind of what this chart shows, is that just sort of with respect to demographics as an influence on inflation, it seems to be kind of flat to disinflationary over the coming decade or so. All right, then the final chart here, Citi U.S. Inflation Surprise Index. One thing that I think is interesting is that you see inflation surprising to the upside towards the end of a business cycle and into the recession. And that seems to be logical to me in the sense that inflation itself is, in my view, actually a brake on the real economy. And then this is also at a time when, if inflation is surprising to the upside, you've got the Fed tightening financial conditions, so a combination of tightening real business conditions in terms of inflation coming through and tightening financial conditions. Not too surprising that is followed by a recession. And so here I would be looking for inflation readings to come out above expectations into the late stages and final stages of this business cycle. This chart relates to both inflation and the business cycle, and you can check out the business cycle chart book for more on that. So to summarize, I think it's important to start out by saying that having confidence about inflation dynamics is really nearly impossible. Even the Fed officials will tell you that they just don't have a very good or reliable framework for anticipating inflation developments. So I've walked through some charts here that I think are relevant and worth keeping track of, but any outlook on inflation should be taken with some caution. Having said that, it looks like near term there could be some base effects still to play out as we get the inflation readings this summer. And over the next, let's say, year or two, it seems to me pretty likely that we could get some inflation readings in the kind of mid to upper 2 to 3% range, both for the headline and core readings, and that could have implications for Fed policy and for expectations and pricing around Fed funds rate. There are a number of factors that play a role here, obviously, in determining inflation. So labor market slack reduction or increased capacity utilization, I think, are important variables. I also tend to emphasize demographics when it comes to the inflation outlook, and the analysis there seems to suggest that we could get some inflationary impetus over the next year or two, and then kind of have a softening or disinflationary effect more longer term with the aging society in the U.S. All right, let me leave it there.